Hello everyone. If you are living in the United Kingdom, drawing a state pension, or relying on private retirement pots to get by, Her Majesty's Revenue and Customs has a massive tax trap waiting for you. Welcome back to the channel, your primary source for raw, unfiltered, and crucial pension news across Great Britain. Today, we are breaking down 4 critical tax changes that every single UK pensioner must check before September 2026. Make no mistake about it, the government is hunting for cash, and the tax authorities are squeezing older Britons harder than ever before. Millions of seniors who spent 40 years working, paying national insurance, and building up their nest eggs are suddenly discovering that they are being dragged into the tax net for the very first time. If you think your retirement income is safe just because you paid your fair share for decades, think again. From stealth tax traps to emergency tax codes that raid your savings, HMRC is quietly moving the goalposts. If you fail to review your financial setup before September arrives, you could find your bank account crippled by unexpected tax bills, coding errors, and automatic demands. We are talking about triple lock pension increases that trigger surprise tax bills, dividend tax spikes that destroy your extra income, emergency tax codes that steal thousands from your drawdowns, and strict property tax reporting deadlines that carry heavy penalties. HMRC will not give you a second chance or send you a polite reminder asking if you made an honest mistake. They expect you to comply, and if you do not act, they will simply take what they decide you owe. Stay tuned until change number 4, because that one is catching thousands of retirees completely off guard. Before we begin, I would like to remind you that many pensioners could be eligible for a new extra support payment of £200. If you have not heard about this yet, I have left detailed information from an official source in the comments below the video. Make sure to check it out. And now, let us move on to the topic of today's video. Let us jump straight into change number 1. The stealth tax freeze meets the state pension triple lock collision. This is perhaps the biggest financial scandal facing British retirees today, and it is reaching a dramatic boiling point before September. For years, the government has kept the personal allowance, the amount of income you can earn each year before paying a single penny of income tax, frozen solid at £12,570. In normal economic times, tax thresholds rise in line with inflation to protect citizens from rising living costs. But by freezing this limit all the way through until 2031, the Treasury is using a mechanism known as fiscal drag to quietly siphon money away from your retirement. Here is where the collision happens. Thanks to the pension triple lock guarantee, the full new state pension has been increased to £12,547.60 per year for the 2026 to 2027 tax year. Look at those two numbers very carefully. The gap between your full state pension and the tax-free personal allowance is now a microscopic £22.40 per year. That works out to less than £2 a month. What does this mean for you in reality? It means that if you receive the full new state pension and have literally any other source of income, whether that is a small workplace pension of £50 a month, a modest payout from a private annuity, or even interest earned on your building society savings, you are officially a taxpayer in the eyes of HMRC. The tax office is using its automated calculation system to send out P800 tax calculation letters and simple assessment notices directly to pensioners' doorsteps. These are not polite requests. They are formal tax bills demanding that you pay basic rate tax at 20% on every single pound you earn above £12,570. Hundreds of thousands of seniors who have never filed a tax return in their lives are suddenly waking up to official demands for hundreds of pounds. Why is September such a crucial line in the sand? Because during the summer months leading up to September, HMRC reconciles the previous tax year's data received from pension providers, employers, and financial institutions. By late August and early September, HMRC updates coding notices and issues simple assessment demands. If you ignore these notices or fail to check your tax coding notice before September, HMRC will automatically adjust your tax code for any private pensions you hold, deducting the tax directly at source before the money even touches your bank account. You must log into your personal tax account or contact HMRC to check that your coding notice is accurate before these automatic deductions ruin your monthly budget. Now, let us move on to change number 2, the dividend tax surge and the unprotected savings trap. If you are a pensioner who took responsible steps to build up an investment portfolio, hold shares in UK companies, or rely on dividend income to top up your state pension, HMRC has set a fresh trap specifically for you. Over the past few years, the government has systematically decimated the tax-free dividend allowance. It used to stand at £5,000, but it was slashed down to a paltry £500. But the story does not end there. From April 2026, the government delivered another blow by raising the actual dividend tax rates by 2 full percentage points across the board. If you are a basic rate taxpayer, the tax you pay on dividend income above £500 has jumped from 8.75% to 10.75%. If you fall into the higher rate tax bracket, your dividend tax rate has soared from 33.75% to 35.75%. Think about what this means for a moment. If you receive £2,000 a year in dividend payouts from investments held outside an individual savings account, you are paying significantly more tax on that money than you did just a short while ago. When you combine this dividend tax increase with frozen income tax thresholds, thousands of pensioners are being pushed into higher tax brackets without actually becoming any wealthier in real terms. Furthermore, savings interest is catching out millions of retirees. Because interest rates on savings accounts have remained relatively high, the Personal Savings Allowance, which allows basic rate taxpayers to earn £1,000 of interest tax-free and higher rate taxpayers just £500, is being wiped out rapidly. If your total income from pensions and state support pushes you into the higher rate tax band, your tax-free savings allowance is instantly cut in half. You must check this before September, because September represents the midway point of the financial calendar. If you hold shares or substantial cash savings in standard taxable bank accounts rather than tax-free ISA wrappers, you still have time to take action before the end of the tax year. By utilizing your £20,000 annual ISA allowance or executing what financial advisors call a BED and ISA transaction, moving taxable shares into a stocks and shares ISA, you can shield your future dividends and interest from HMRC's greedy hands. If you wait past September, you risk accumulating an unexpected dividend tax liability that will force you into the nightmare of HMRC's self-assessment regime. Now, pay close attention to change number 3, the emergency tax code nightmare on pension drawdowns and the new lump sum limits. This is an absolute scandal that is costing British pensioners millions of pounds every single month, and if you plan to access your pension pot before autumn, you must pay strict attention. Following the total abolition of the old lifetime allowance, HMRC introduced 2 new rigid limits: the lump sum allowance, which caps your tax-free cash withdrawals at £268,275 across your lifetime, and the lump sum and death benefit allowance set at £1,073,100. While these high thresholds sound like they only affect the super wealthy, the underlying administrative changes have triggered massive disruption for everyday pensioners withdrawing small cash lump sums. When you decide to take a flexible withdrawal from your defined contribution pension, for example, taking £5,000 out to pay for home repairs, a new car, or a holiday, HMRC's automated payroll software automatically applies an emergency tax code on a month 1 or week 1 basis. What does this mean in plain English? It means HMRC assumes that the single withdrawal you made today is going to be paid to you every single month for the entire year. If you withdraw £5,000 in one go, the tax system treats you as if you are earning £60,000 a year. As a result, HMRC instantly slices off emergency tax at 30 or 40%, seizing thousands of pounds of your own money that rightfully belongs to you. Retirees across the country are left in total shock when they check their bank statements and realize that a huge portion of their pension withdrawal was stolen by an automated tax calculation. And here is the catch. HMRC will not automatically refund this money to you immediately. If you do nothing, they will hold on to your cash until the end of the tax year reconciliation process, which could mean waiting over a year to get your own money back. To reclaim your overpaid tax before September, you must take active control of the situation. You need to file specific tax forms directly with HMRC. If you have emptied your pension pot entirely, you must submit Form P53Z or Form P50Z. If you have taken a partial withdrawal and plan to take more, you must submit Form P55. Once submitted, HMRC is obligated to process the refund within 30 days. If you fail to check your pension statements and file these forms before September, your hard-earned savings will remain trapped in HMRC's coffers while you suffer the consequences of their administrative blunder. That brings us to change number 4, capital gains tax 60-day reporting rules and the pension inheritance tax trap. The final major tax change you must check before September 2026 revolves around property sales, asset transfers, and the changing landscape of inheritance tax. Many pensioners in their 60s and 70s decide to downsize, sell an investment property, or transfer assets to their children or grandchildren to help them get on the housing ladder. However, HMRC has tightened the screws on capital gains and gifting in ways that catch out unsuspecting seniors every single day. First, if you sell a residential property in the United Kingdom that is not your main home, such as a rental property, a holiday home, or a house you inherited from a relative, you are subject to strict capital gains tax rules. You no longer have until the end of the tax year to report this transaction. Under HMRC regulations, you must report the sale and pay the full capital gains tax due within strictly 60 days of the completion date. If you miss this 60-day deadline by even a single day, HMRC will automatically issue monetary penalty points, late filing fines, and daily interest charges. With the annual capital gains tax exemption reduced to a tiny £3,000, almost any property sale generates a taxable gain. Pensioners who assume their accountant will deal with it at the end of the year are receiving nasty penalty notices through the post. Second, HMRC is scrutinizing lifetime gifts and property transfers far more aggressively. If you attempt to transfer property or large sums of cash to your family to avoid future inheritance tax, but you continue to benefit from that asset, for example, living in a house you gifted to your daughter without paying market rate rent, HMRC classifies this as a gift with reservation of benefit. This means the entire value of the property remains inside your estate for tax purposes, completely destroying your tax plan. Furthermore, with government policy shifts moving toward bringing unspent pension funds into the scope of inheritance tax, the traditional advice of leaving your pension untouched as a tax-free inheritance for your children is being radically altered. Why must you review this before September? Summer is the peak season for property transactions and estate restructuring in the United Kingdom. If you complete a property sale or make significant financial gifts during the summer months, checking your reporting requirements before September ensures you hit the mandatory 60-day deadline and document your gifts properly before HMRC launches an audit into your affairs. Let us recap what we have covered today. The financial landscape for UK pensioners in 2026 is more perilous than ever. Between frozen personal allowances of £12,570, state pension triple lock increases, leaving a tiny £22 margin, dividend tax rate hikes, emergency tax codes on pension drawdowns, and strict 60-day property tax deadlines, HMRC is watching every move you make. Do not let the tax office catch you sleeping. Before September 2026 arrives, take these 4 immediate action steps. Number 1. Log into your HMRC personal tax account and check your coding notice to ensure you are not being taxed incorrectly on your state pension or workplace pensions. Number 2. Review all non-ISA investments and savings to ensure you are not exceeding your slashed dividend and interest allowances. Number 3. If you have withdrawn cash from your pension pot and suffered emergency tax, submit Form P55, Form P53Z, or Form P50Z immediately to get your money back within 30 days. Number 4. If you have sold a property or gifted significant wealth, ensure you have complied with the 60-day reporting rule and kept flawless records. Knowledge is power, especially when dealing with the tax authorities. By taking action today, you can protect your hard-earned retirement, keep your cash where it belongs, and avoid paying a single penny more in tax than you legally owe. If you found this breakdown helpful, please smash the like button right now, share this video with your friends, family, and fellow retirees, and hit that subscribe button to stay informed on all the latest United Kingdom pension news and tax updates. Leave a comment down below letting me know if HMRC has hit you with an unexpected tax bill this year. I read every single comment. Thank you for watching, stay vigilant, and I will see you in the very next video.